Thank you everyone for joining and welcome to this webinar on the Q2 2020 release of the unlisted EDHECInfra infrastructure equity and debt indices. So I'm very glad to see so many of you join this session. Every time it's at least 100, sometimes 200 people who join, so that's quite nice to have this level of interest in our work. And indeed, this is quite timely results. Today, we look at what happened in unlisted infrastructure for the last quarter. Since we published the Q1 results, we'll look a little bit back also at the Q1 results to compare the different effects, the different impacts on returns. And we'll see what happens when you try to mark to market unlisted infrastructure assets. Okay, so your host today, I'm Frederic Blomberg, as Natalia was just saying, Director of EDHECInfra. I'm joined by Abhishek Gupta. Abhishek, you there?
Yes, hello everyone, and welcome to this webinar.
Hello, Abhishek. And this is just a few matters of housekeeping very quickly. So we'll talk about half an hour. We'll keep a bit of time for questions. There'll be a Q&A session, but also a poll. So we do this every time now. So we'll look forward to also to your insights. And we will record this webinar, okay? And all the questions will be in writing in the Q&A tool of Zoom. Another little introductory slide, which I do every time, but just in case you don't know EDHECInfra so well, very briefly, EDHECInfra was originally an academic project at the EDHEC Business School, funded by public and private sector grants, research grants. For 5 years, we developed our technology and our data, and today we are a commercial provider of indices for unlisted infrastructure investors. Okay, we produce several hundred indices and sub-indices every quarter. And these indices are now used by major investors in the sector, in North America and Europe and Australia, etc., for investment research, for asset allocation, to monitor specific mandates, and also to understand and to manage risk in the infrastructure portfolio and in the broader portfolio as well. So our agenda today is, first of all, I'll give you also a quick reminder. I do this every quarter. For those of you who are less familiar with what we do or just need a bit of a refresher about our coverage and how we approach the measurement of performance. I won't go too much into the details, but it's important so you kind of get what happens next. Then we'll do a review of the Q2 results as promised and see what happened for this quarter. It's not going to be very pretty, but there is a silver lining. There's maybe a couple of silver linings. But there's still some serious, some negative performance basically across the board in the universe we track. Then my colleague Abhishek will take you further into these results and describe 3 different things for you. He will describe the contributions to the return, and so what different segments of the market, the infrastructure market, explain these returns. He will look then into the impact of changes in cash flows versus changes in interest rate versus changes in risk premia on the returns. And this is important because, of course, this is all DCF, so you want to understand what's going on, especially now with future cash flows versus changes in risk pricing, and the impact of monetary policy, obviously, on interest rates. And finally, he will show you, which is, I think, now becoming a classic, the state of our peer group portfolios. So asset managers, large asset managers versus large asset owners versus the market. Who's winning? We'll see. And then we'll do a poll and a little very brief conclusion, and we'll have then your questions. First, let me just tell you a little bit about our coverage. So what you're about to see. Okay, so our very much since the beginning, our objective has been to build a representative database, to have a representative indices, okay, that can actually show you what's going on in this market. So to do this, we've identified 25 markets, which are the most active markets in the world in terms of investors buying and selling unlisted infrastructure companies or investing in infrastructure debt. So these are the markets which are obviously where they're the most transactions, and also most importantly, the most secondary market transactions. And for these markets, for these 25 countries, of which there's a list on our website. For this market, we then identified all the unlisted infrastructure companies that could be invested in or lent to if you're a debt investor. And we found roughly 5,500 of these companies. So this is basically the universe. This is the investable universe in these 25 major markets, which are all the markets you can imagine. We sized up these 25 markets and these 5,500 companies. It's about 2.5 trillion of total asset book value at the end of last year, and it's split according to the chart you see on the left. Okay, so that's the market, that's the universe we're tracking. And then in order to track it, we can't collect and analyze data for 5,500 firms. That would be a lot. And also it's not necessary because there is, we can sample and build a representative sample. So we've put together collected information for more than 650 companies over these 20 years. That corresponds to roughly 2,300 also debt instruments that are on these companies' balance sheets. These are all private companies, unlisted projects and corporates in the infrastructure sector. And the way we decide to build the sample is to try and match basically the structure of the market. In terms of coverage, we try to reach at least 50% of each country by book value. And in terms of sectors and other aspects, we try to best match basically what the market looks like, so that we have a representative set. By doing this, we avoid a lot of problems that you normally have in unlisted asset indices, which is all these biases. So if you look at Preqin index or stuff like that, you have reporting biases, you have survivorship biases because the data is contributed. So there's a whole bunch of reasons why it's not just what's in the market, but it's what remains in funds after a while. Here we have a view of what was in the market at each point in time. So we won't have a problem of survivorship bias, which means that we will see more companies failing as well, which is interesting because we will understand the risk better. Okay, so this is the market that we track. So if you split it by segments, so we have this classification of infrastructure companies called TICCS. It's a universal standard for classifying unlisted infrastructure companies. It's used by many investors nowadays. And if we map this market, so we've done that, we've mapped all these 5,500 plus companies to TICCS, and we get this split between, for example, on the left, the contracted type of infrastructure companies versus merchant versus regulated. And this is weighted by size. And in the middle, you see the split by what we call industrial activities, for sectors basically. And on the right-hand side, the split between corporates, so regular corporations that are infrastructure businesses, and SPV, so that's projects. SPV stands for special purpose vehicle, so it's project finance. So you see that's how we've documented the investable universe over time. Sorry, that's not over time, that's the latest picture, but we have this over time. And we use this then to build our indices. So for example, if I show you this picture, which on the left-hand side is the infrastructure 300, which is one of our main indices. And on the right-hand side is the same universe that I was just showing you. You can see that most of in most cases, for most buckets, we're very close. It's not always perfect. For example, if you look on the right, we have probably more projects and probably not enough corporates. So this is something we're trying to adjust as we collect and as we aggregate data. Of course, data collection is a difficult thing to do, and we have a whole team of people who do that. And it's a difficult thing to have the perfect sample, but we build the sample and the index constituents that are the most representative as possible. The advantage here is that this is perfectly transparent, right? So it's not perfect, but at least you know exactly what comes with these indices. There is no hidden sort of biases. Okay, so this is how we build our indices based on the data that we collect. Now, let me just tell you a little bit about how we treat this data. So once we have all this historical information about these companies, these 650 companies, which make a representative sample, we have a team of analysts which go through each company individually, which puts together a very detailed account of its financials, of its financial structure, of the events, etc., everything that happens to this company, and basically gets a very in-depth understanding Usually this is also analysts that are specialized by sector and by parts of the world to a specific understanding of what this company is like, which allows us to make revenue growth forecasts and debt service forecasts for these firms. And based on this analysis, which is basically the kind of analysis that corporate analysts would do, given all the details, we then have a stochastic model of free cash flow, which allows us to predict dividend. So this is based basically on the history of all these companies. We have 20 years of history of what infrastructure companies are like, when they pay dividend in their life cycle, how much they pay as a proportion of their free cash, given how much leverage they have, etc. And we're able to predict a stream of dividends for all these companies at each point in time, based on their revenue forecast and all their financial characteristics. That's what you would basically do for any company valuation. And again, this is the work of a team of 7 people that basically does this year round and updates this information every quarter. And the other thing we do, which is the bottom part of the screen, is to collect price information. So we look at how much investors pay for infrastructure companies when they buy the equity, or what the spreads are like when lenders lend to infrastructure companies. And we use these prices, that's real market prices, to calibrate a model of expected returns. So in the case of equity, it's an equity risk premia model. In the case of debt, it's a credit spread model. To calibrate this model and to recalibrate it every quarter, so that every quarter, as new transactions take place, we're in a position to reset a little bit, or to readjust a little bit the latest risk premia that applies to these companies. And the trick is that instead of having to price hundreds of companies every quarter, all we have to do is price 6 factors. Now we have a factor model which has 6 major factors plus a few control variables. And if we can figure out the price of the premia basically for each one of those risk factors in each quarter, then once we have this price, for example, for the leverage factor, the profit factor, the size factor, etc., then any company that has a size, a leverage, profitability, etc., which we can observe, can be priced, right? It's just a matter of knowing what is the premia for different factors, and we know what the factors are for all the companies that we're tracking, because it's in their financials. This is something that we know. So let me not go too much into the details about this, because it can get quite technical, and we've already done presentations about this. But basically, that's how we do it, right? So every quarter we readjust the cash flow information and projections, and every quarter we readjust the pricing information, in particular the risk premium information. And this is why we can say that we're targeting fair value, the fair value of infrastructure companies, because, or marking to market, so to speak, because we're calibrating our valuations on a consistent basis for all the companies in the cross section at every point in time, based on the latest market data. Okay, so having done all this intro, let me show you what we found. So this quarter, so at the end of June, we see negative returns, but we see that contracted infrastructure is not doing so badly. So, and the debt is also not doing so badly. So let me show you. Right, this is the Infra 300, so the same index I was showing you before, in terms of its weights by business risk or sectors, etc., and how it's performed over time. So you can see that in the latest quarter, it's negative -1.5. So this is a quarterly rate of return. And because interest rates are basically at 0, the excess return is the same. It's now getting close to 0 return, back on 0.8 on a 12 months basis. Okay, so obviously we're seeing some serious impact in terms of the impact of COVID, and this is also compounded by the fact that at the end of 2019, as Abhishek will show you in a minute, there were also negative returns. This time due to a quite significant hike in interest rates, which had a big impact on the DCF valuations. So it's been 3 quarters of negative returns, the biggest one being Q1, of course, where we had a huge impact of the first effect, if you want, of COVID-19 lockdowns. And then in Q2, we have a slightly smaller, but still negative impact on the whole index. If you look further back in time, incidentally, it's still looking like infrastructure. 10 years ago, we on a 10-year basis, at least, we still have double-digit returns. That's because, as you know, 10 years ago, returns were higher. Looking closer into time, we've still been sort of 7 and 8% return on a 3 to 5 year horizon. Incidentally, if you watched our latest webinar on risk, let me highlight that the Sharpe ratio of this index at 0.6 to 0.8 in the most recent years is still very attractive, but it's not crazy 3 or 4 Sharpe ratio like you see in appraisal-based indices. So we're all good. But this is obviously not the very positive quarter. Now, let me give you a little bit more details. So what we do to get these results, as I was saying, first we update the cash flow. So every quarter we will, the team will look into these revenue forecast assumptions and update them as and when new information becomes available about what's going on, about each asset and also each sector and each country. And so we, excuse me, we understand as time passes and as we track these companies that, for example, the revenues of this airports are going to be much lower, the traffic on this or that road is going to be lower, etc. And so we update our view every quarter, and the team publishes a report. So I'm not going to go too much into the details about that as well now, because that's on our website. But the team publishes a report which describes all the its view on all the sectors, and also any assumptions that are made about how much the revenues are impacted by the recent events for the next 3 years. Okay, and then this data obviously trickles down in the individual company dividend forecast. What happened in Q2 was that more sectors that were impacted beyond transport. So in Q1 it was all transport, of course. It was all the merchant transport assets that were impacted by the COVID-19 lockdowns. Now, as economic activity has slowed down considerably, we see other types of infrastructure being impacted by basically less demand for their services, in particular utilities, gas, water, and power, especially industrial use of gas, for example, or of water. So that's the cash flow. So we have effectively a lower cash flows. We also have assets that we know to be effectively in lockup, either because they are in lockup or because they're taking part into a rescue package. In a rescue package, for example, in the UK, you have some rail companies that are being bailed out. They're as a condition, they can't pay dividends for the next year or the next 2 years, etc. So all of these things are taken into account to look at the future cash flows of these companies. Once you've understood that, which is the object of a huge amount of work and a huge amount of research every quarter, you need a discount rate. So this is where the risk premia analysis comes in. So this is what I was just describing. If you look at the table on the right, you see that we've seen quite a significant increase in the risk premia between Q4 and Q1. So this is the sort of fear factor of COVID, almost 100 bips increase in the risk premia in both the Inf 300 and the broad market infrastructure index, which tracks more than 500 assets. And in Q2, there's also an increase, but it's much smaller. It's around more like 20 bips, okay? So you could say that to some extent that in terms of risk pricing, a lot of the COVID impact, at least the initial one, has been priced in now. And it's mostly the cash flows that are going to have an effect on the valuations. On the debt side, it's interesting to see that project finance debt basically didn't budge that much. The spreads went up a little bit, but not too much. All the deals that were closed, in fact, if you look in Q2, had slightly higher, spreads. I think some of the flex sort of conditions were called in order to increase the spreads a little bit, but it was very limited compared to corporate debt, where spreads went up a lot in Q1, but now have decreased a little bit in Q2. Right? So based on all the market information that we can observe, this is the estimate we have of these risk premium. And then, of course, the third element in the DCF that we do for each asset is the interest rates. And so here we have an interest rate curve for each asset in each country, or using the yield in that country at the end of each quarter, and also at the horizon of the asset, of course. So if you have 20 years of asset life, we take a 20-year curve. If we have 30 years, we take a 30-year curve. And here we know that in Q2, most of the time interest rates have gone down. So we'll have that effect as well. This is how we arrive at these results, by sort of estimating all these different elements. And then in a minute, Abhishek will show you the impact of each one of these things on the returns. But before that, let me just show you a slightly more granular results. So beyond the infrastructure 300 index, which is a global index, and again, is built to be representative of the market underneath the universe. We have, of course, lots of other indices, which are quite, which are of course much more specific, and we can slice and dice our universe. So, for instance, we have a contracted index, we have a merchant infrastructure index, we have an airport index, we have wind index, etc., wind power index. And so, if you look at on a year-to-date basis, the combination of Q1 and Q2, you can see that if you have the ability to track the performance each quarter like this, but also with this breadth of information, this breadth of data, you can see very different results. So actually, depending on your infrastructure portfolio and your infrastructure specialization, your exposure and your performance this year will be very different, right? Of course, you can see the merchant assets, in particular merchant roads, have been hit the most, now minus 16% on a year-to-date basis. Someone asked me very recently why the airport companies have a lower return, a lower drop, so they're minus 12 instead of minus 16 for roads. And the answer is very simple. It's because airports have a much longer life. They're 40, 50, 60 year of asset life. So there are many years of cash flow still to discount. And so whatever you've lost in the next quarter and then in the next couple of years because of COVID, assuming that there's a recovery eventually, proportionally to the entire value of the assets, it's actually less than for roads, because road contracts, road companies or concessions would typically be 20 years, 25 years. Well, there are some much longer ones, but there are many that are in this sort of bracket, or at least that's what's left on the contract. And so if you've lost 2 or 3 years of income, you've lost proportionally a much larger share of the whole value of the asset, right? So that's why the returns are even more negative. Another thing that's interesting, if you look at things this way, is that wind power companies, which of course have usually contracted and quite stable cash flows, still have negative returns. And that's because of the hike in the risk premium. So independently of how stable the cash flows are, if you increase the risk premium, because we see in the market that the price of each risk factor, so for example, leverage is a big driver of the risk premium, and these wind power companies are quite leveraged. So if the price of the leverage factor goes up, if the premium goes up, it's going to increase the wind power companies' discount rate, and it will have an impact on their valuation. So we see here the different effects, and also the fact that if you look at this over a longer period of time, you see some very interesting characteristics also in terms of risk, of course. So you can compute the value at risk, you can compute the maximum drawdown, etc. And you can understand also the impact of interest rates, because the duration of each one of these segments is very different. As you can see on the right-hand side, we also talked a lot about duration during the last webinar. The broad market is about a 12-year duration, 12%. But some assets have longer durations and some have lower durations. So they're impacted very differently by movements in the discount rate. And I'll talk a bit about debt in a minute as well, but you can see on the bottom of that table that debt has behaved quite differently. So we don't have negative returns on a year-to-date basis. We had a slight negative return on the infrastructure corporates in the first quarter, and that was because of that big spike in credit spread, which wasn't fully compensated by the drop in interest rates. But as you can see so the infrastructure corporate debt kind of caught up quite well in Q2, but on a year-to-date basis, infrastructure project debt is still ahead. And I think I'll show you in a minute, it tends to be ahead most of the time. Right, actually, yes, so talking about debt, this is also our global debt index. So that's all infrastructure, private infrastructure debt, both corporates and projects. And you see here that it has been much more stable. It has been much less impacted by COVID. right? At least in terms of the impact we've seen on the risk premia, on the cash flows, and the fact that, of course, the mark-to-market valuations have been supported by lower interest rates. We see that the returns on the one-year basis are pretty much in line with the historical returns at close to 6%, and that this quarter is not bad at all. If you look at the bottom table, you can also see that, of course, the yields have compressed, but overall we see that the characteristics of the debt asset class has not changed fundamentally. It's not been changed fundamentally by the last couple of quarters, or not been impacted fundamentally rather by the last 2 quarters. If we compare on the debt side the corporates versus the projects, again, a little bit more details, we see that over time, so that's what I was showing you just now. In Q1, we had a slightly negative return for corporate debt, infrastructure corporate debt. So again, that's the debt of large airports and pipeline companies, whatever, anything that's not a project finance. But in Q2, it's thanks to a drop in spread, in credit spread, and also a drop in interest rates, we have quite a significant return of 3.16, catching up with project finance debt. And here you can see that the characteristics, however, over the long run remains that project finance debt has been outperforming corporate infrastructure debt for quite a few quarters now, and even on a 10-year basis, it's ahead. And so it's interesting to see that basically these 2 types of debts are priced completely differently into completely segmented part of the credit market, and have very different characteristics. Okay, so that's the big picture of what we found. So now let Abhishek take over and show you in more details what the contributions and the story behind the returns is.
Thank you, Frederick. Let me just share my screen. Can you confirm if the screen is visible?
Yes, it's good. Go ahead.
Okay. Hello, everyone, and hope you found the overview of these Q2 results quite interesting. I'll now drill down a bit deeper in these results. First, I want to show you the contribution by different segments to this quarter's return. And as you would know by now, we follow TICCS classification standard for all the infrastructure companies in our universe. And this contribution exercise is also based on the same classification system. First, in this slide, we see the contributions of 3 different types of business risks to the return of Infra 300 index in this quarter. First thing to note is the positive contribution of contracted companies. Right here, we know that these companies have a relatively stable cash flows, and thus they continue to outperform rest of the infrastructure market in the times of COVID-19 crisis. The return was better in Q1 as compared to other business risks as well. And even in Q2, they have outperformed the other business risks. They had slightly more than 0.1% contribution out of the total minus 1.5% return of the Infra 300 index. Then second, we see regulated companies such as utilities. They also felt the indirect impact of lockdowns as the economic activity slowed down in this quarter, and they contributed minus 0.6% to the index return. Merchant assets, they were significantly hit in Q1. If you remember, their average return in last quarter was less than 8% as a result of their immediate shutdowns. And their misery sort of continued in Q2. Their further reductions were made in their revenue projections based on the data available from the market, such as traffic data for roads and air traffic data for airports, which was now available in this quarter. And in effect, they have contributed more than negative 1% return of the Infra 300 index total return in this quarter. We can see these contributions by industries as well, or the sector groups. And first thing to note is the utilities. And they were very heavily impacted by the lower non-household usage and suffered the most in this quarter. This effect wasn't very transparent in the first quarter, but in Q2, we adjusted their revenue growth projections based on the market data, which was available now. They contributed almost half of the negative returns of the Infra 300 index. Second, pipeline companies, which are grouped here under energy and water resources, were the second largest negative contributor to the Infra 300 index return. This is, we believe, likely the result of the global oil supply shock, which we had seen in this sector in this quarter. Lockdowns were extended worldwide all the way until the start of June, when the economy started to open up. And as a result, we started to see the actual evidence of the hit on the revenues of transport companies, such as airports, roads, rail companies. And we revised our revenue projections in line with this data, and the sector suffered again in Q2. They contributed around minus 0.45% of the index return. Next, this is a very interesting result showing the difference in the contributions of corporate versus project type companies. And if you remember, projects make up more than 70% of the Infra 300 index, as there are many more in number, and this index is equally weighted. But yet their contribution to the total return was merely minus 0.1%. That means on an aggregate basis, they have significantly outperformed corporate companies. And this follows from our previous conclusions that project companies, such as contracted renewables or social infrastructure, they have been better performers in this quarter. In contrast, corporates, which consist of sectors such as utilities and then some airports as well, they have done much worse. They were responsible for more than 90% of the negative return of Infra 300 index, so close to minus 1.4%. And continuing this, let's briefly look at the contributions of sector groups to the debt index return. Here we consider our broad market value weighted index in local currency. Frederick showed you that debt had a positive return in this quarter, and also how the spreads of corporate debt reduced in this quarter. Further, we know that interest rates worldwide were reduced as the economic activity slowed down. So there are basically two effects in play here: the lower spreads and lower interest rates. And combined these two effects, they had a positive impact on the valuations, and more so for the sectors which had long duration debt. For example, utilities and transport, there are some of the sectors where debt issued is of very long duration, and they performed much better as compared to other sectors here. These sectors also have higher allocation in the overall index by value, and that's another reason why their contribution was the largest in the index. So we have seen the absolute contribution of these different segments to the index return, but it is also important to understand what drives these underlying valuations. As you know, that we compute mark-to-market valuations every quarter using a discounted cash flow model, and we can see the effects of the different DCF components. We had first shown you this analysis in a webinar, which was in June 2020, end of June last month. And since then, this has become a standard for us to review our quarterly findings. And it gives a very good view of the three components of discounted cash flow model, that is future cash flows, interest rates, and risk premia. In this analysis, we can isolate the average effects of each of these components by changing them one at a time. So in other words, as it says here, that we can see the quarter-on-quarter impact on these mark-to-market valuations if we only change one of the DCF components at a time. And let's start with this table. First, I'll give you a bit of a structure here. This first column in this table here shows you the NAV change from Q1 to Q2 2020. So it's a quarter-on-quarter change in basically this period, this quarter. The second column gives you the quarter-on-quarter change as of Q1 2020. So the valuation, how it has changed from Q4 2019 to Q1 2020. And then the third column shows you the change in the last quarter of 2019. And we can see these valuation changes by different effects of DCF models. So first we look at the effect of cash flows, then we look at the effect of interest rates, and then risk premia. Now, if you notice here in the last line, this shows the aggregate impact of all the three components together. And as Frederick was highlighting earlier, the valuations have been going down for the last 3 quarters. This is visible in these aggregate impacts. But the reasons for these 3 drops are quite different. Let's start with the first one. The majority impact is driven by the lower future cash flows. And that's due to the revenue growth projections that we have made across more sectors besides transport alone. So the utility companies, the power companies, and some other partially contracted companies were also impacted in this quarter, and their cash flows were revised. The impact of interest rates and risk premia partially offset each other, and the bulk of the impact remains due to these lower cash flows. In comparison, if we see what happened in Q1 2020, the cash flows did play some role in the lower NAV, but bulk of the effect was driven by the increased risk premia. So then the jump in the risk premia was more than 100 basis points in Q1, which indicated a systematic shift in the riskiness of all the infrastructure companies as we measure using our factor prices. And finally, in Q4 2019, so in the pre-COVID times, the majority impact of the valuation came from the increasing interest rates, which were basically higher in most parts of the world as the economy was doing well. And it caused negative 2.5% reduction in the valuation. There was some impact on the valuation by increasing risk premia, but it was comparatively smaller. So a quick point on this slide. I find these results quite interesting because it gives a clear picture of how the valuations have dropped in the last 3 quarters, but the reasons are completely different if we look at the underlying DCF components of these valuation computations. And our methodology allows us to look at these effects clearly and their magnitudes as well. Now, moving on, but on the similar lines, we break down the effect of Q2 NAV drop by different business risks here, and also by different DCF components. So we have 3 business risks and the same DCF components as we looked at earlier. The first thing to note is the large drop in revenue projection for the next 3 years in merchant companies, and it's almost close to 10%, by far the largest in this group. This resulted in bulk of their drop in NAV in this quarter, which is more than 5% in this just in this quarter alone. The effect of interest rates and risk premia almost netted off each other. So the aggregate impact was primarily driven from these lower dividend forecasts. Interest rates actually were lower across the board. So and their impact on the valuation was positive as a result for all the 3 business risks. And finally, we look at the risk premia. We see that the jump in risk premia is also the largest for merchant companies, which indicates their higher riskiness as compared to other business risks. And in aggregate, we see the contracted companies did much better in this quarter, and their average change in NAV was less than 1%. Now we do the same analysis for different industries, and here our team of analysts does an incredible job to follow different sectors quite closely through the reporting of different companies in different countries and certain regulatory sources as well. Based on that, they form a view on each sector in different geographies and make a revenue growth projection for all the companies in our universe. This allows us to see the impact of different, the way in the revenues change across different sectors. Furthermore, they've explicitly set some companies under dividend lockups in this quarter, That's due to the government regulations and also the announcements by different companies. Here, the first thing I want to show you is what we noted earlier, the impact of utilities and transport sectors on the total index was the largest. Their contribution was more negative than other sectors in Q2. And that's due to their average change in annual revenues, which is by far the largest across these sector groups. For utilities, it causes an impact of minus 4.81% on the valuation. And for transport, it's also close to 4% drop in the valuation in this quarter alone. Second thing to note is the aggregate impact on social infrastructure companies right here. We see that this impact is actually positive because their revenues weren't reduced because of COVID-19 lockdowns, at least so far, unless the government start defaulting in future, who knows. But so far, we haven't amended their revenue projections. So the bulk of the effect on NAV comes from the lower interest rates and the increase in risk premia, and interest rates dropped more. So the net effect was basically positive for social infrastructure. And lastly, I wanted to highlight this impact of duration. We see the transport companies have the longest duration, 11.4 as compared to other sector groups shown here. So their impact on NAV was also the highest, and they benefited most from the lower interest rates in this quarter, where the NAV jumped by more than 3%. And I'm sure you see the trend by now. We look at this analysis by corporate governance structures. We had pointed out earlier that corporate companies consist of utilities and airport sectors and typically follow merchant or regulated business models. And we saw that the financials of these segments were more severely impacted by COVID-19 as a result of the lockdowns that were imposed. They have, on an aggregate, a more than 5% drop just due to the lower revenues and in turn, the lower revenue dividend forecast. Whereas projects in comparison did much better and saw an impact on NAV of 2.25%. A thing to note here is that projects have a bigger drop in interest rates on average. That indicates that they are based in countries which actually saw a larger drop in interest rates in Q2. That includes some countries such as Spain and Italy, where interest rates weren't reduced in Q1, but rather in Q2. So that's why this effect is different between projects and corporates. And in terms of the aggregate impact on the NAV, corporates had almost four times worse NAV drop as compared to projects. Then moving on to another quite interesting analysis. In our second webinar in May, we had presented two peer group portfolios representing large investor groups, that is asset managers versus asset owners. Their investments were selected based on the real transactions made by them, and then pooled portfolios were created using their stakes and entry and exit dates information obtained from public sources. Let me quickly give you a recap of what these portfolios look like. Here you see a brief summary of these portfolios as of Q1 2020. Asset managers portfolio is made up of 118 companies in total, including 54 exit companies and 64 live companies as of Q1. Whereas asset owners portfolio included total 31 companies and only one exit over this time. The key message here is that asset owners portfolio is more concentrated in some large companies, whereas the asset managers portfolio is more diversified just by the number of companies that are included in the portfolio. Next, we quickly compare the allocation, and this is all already available in our webinar from May. So if you want more details, it's available in that video, and slides would have been shared as well. But just two important things to note here. One, asset managers have more merchant companies and they have more project companies as compared to the benchmark. So I want you to remember these 2 points here. Whereas if you see asset owners, they have more corporate companies instead and fewer merchant companies in their portfolio. So asset managers, more merchant companies, more project companies, asset owners, more corporate companies, and fewer merchant companies. And now with this understanding, we can look at how their portfolios performed in COVID-19 crisis. We find, first of all, that both peer groups continue to outperform the benchmark on a long-term basis, as well as in the COVID times. They have had superior returns. So if you look at on an year-to-date basis right here, they have had better return than the benchmark. Then next, their behavior was different in COVID-19. So in Q1, asset managers suffered more than asset owners, and they actually had worse performance than the benchmark. This was due to their higher allocation to merchant assets. And as we said, merchant assets were the first ones to be impacted in Q1. But they make up some of this damage from Q1 by being by having higher allocation to projects, and they outperform in Q2. So in Q1, while they suffered more due to more merchant, they made up some of it by being overexposed to projects. Corporate companies, on the other hand, the asset owners, on the other hand, sorry, they have higher concentration to some large corporates, and their cash flows were more impacted as a result of COVID-19 crisis. So they have lower performance as compared to the benchmark in this quarter. And okay, this is it from my side. I hope you found this deep dive in the Q2 infrastructure returns quite useful. I'll now hand it back to Frederick, who will conduct a poll and then conclude the presentation with some final remarks. Frederick?
Yes, I'm back. And can you see the poll now?
Yes.
Okay, so let me just well, actually I could just start it, I guess. I'm going to launch this poll. So just to first let's talk about the questions. We would like to have your view on whether this has all been priced in now. It's basically behind us. We've had this shock, and we've seen this increase in risk premia, and the cash flows are lower, but they're not. They can't go that much lower because there's only so much shutdown and you can have, etc. Or if on the contrary, we'll see an increase in expected returns basically in this sector. The other question we have is that obviously there's a very different type of behavior, at least for now, between debt and equity. This makes perfect sense. Huh? But I was wondering if our audience thought that this meant infrastructure debt suddenly became much more interesting, because of course it's been, while most infrastructure is debt financed, equity has really been the focus for investors for many years now. So let me launch this poll that will allow you to answer whether you think that discount rates, so expected returns, will you have a right not to know, will stay where they are now, or will continue to increase, and whether infrastructure debt becomes increasingly attractive in this context. Okay. We have about 25 people have answered so far. Come on. Give us your opinion. A little bit more effort for some of you. We're starting to see a winner. Huh? Interesting. I'm going to give you another 30 seconds to express your views. We can get to a slightly higher sample. We'll make all these results that much more interesting, of course. Come on, 2 more people, and then I think we'll have a good sample size. 1 more. There you go. Okay, so oh, there you go. We have even more people now. Okay, so let me stop the poll and share the results with you. Okay, so you can see, you should be able to see now the answers. So you can see the winners. The winners are that expected returns will stay where they are, basically between 7 and 7.5, and that's 50% of you. A quarter of you admit that they don't know. It's probably wise, but only 7% of you. So it's very few people, because we only have 45 people who contributed, think that they will actually keep increasing above 8%. Of course, this is important because we've seen a huge decrease in the risk premia and in the discount rate in general for the past sort of 10 years. Not only because interest rates have been lower, but because the risk premia has decreased a lot. And that's, again, based on what you see in the secondary market. You see the investors willing to pay more for the same risk, you know, more money at a higher price for the same risk. And that's something you're all aware of. And one question is whether we've achieved a sort of stable level of pricing now. In fact, someone was asking in the chat while Abhishek was talking about the movement of especially the positive movement in terms of premia at the end of last year. And from what we can tell, looking at price levels and price ratios in particular in actual deals, we've reached a peak about a couple of years ago. Since then, it's been pretty stable. And so the question of whether it will stay at this level, it's kind of the fair level, if you want, or whether the price of risk becomes higher is an interesting one. Now, just to conclude, before we break off, because it's been an hour, so we're out of time. What do we conclude about? What do we conclude about this? Well, so far we know that COVID-19 has led to lower revenues. That's pretty obvious for the next 3 years, depending on the different sectors. And I invite you to look at this report on our website, depending on the sectors. And this is an asset level research. We have lower revenues and, of course, lower dividends, especially for all the assets that have basically the equivalent of lockups or actual lockups. We have a higher risk premia. That's pretty clear, but we don't necessarily think that they're going to go through the roof. They're a bit higher, and interest rates have dropped, but they cannot go much further. So it could seem like pretty much the impact of COVID-19 is behind us. It's priced in. It's it happened, but it's obviously not given. The other thing that, of course, has started to happen in Q2 is the fact that more sectors were impacted by the COVID-19 lockdowns because we see a decrease in economic activity. Of course, this reminds us again that infrastructure is related to economic activity, at least the non-contracted part. Contracted infrastructure has proven to be resistant. So as I always like to joke when I teach about this, you know, it's contracts, not concrete infrastructure. It's all about the contracts. And it's here with contract business models, it's obviously the proving to be something that is more COVID proof. And of course, this will also then show in the different portfolios and the different strategies. This being said, what happens next? Well, it will all depend. And so we will update our views on the cash flows at the asset level, depending on the country, the regulation, etc. And also what happens to each asset, depending on how long this recession and how bad this recession is going to be. And as someone pointed out also during the webinar in the chat, eventually this could lead to some counterparty defaults. And so the counterparty risk that we have in contracted assets could, at least in some countries or in some sectors, become more real or more realized. I mean, they're still there, of course, they're already there, but they could become realized. So far, we haven't seen really reasons to believe that this will be a serious concern. The good news is that infrastructure remains infrastructure, but again, maybe you're just seeing it for the first time. Thanks to COVID, you're seeing how it is related to the real economy. It is something that has a volatility. It is something that has a duration. When you invest in something that has 20 or 30 years of cash flow, of course, the valuation changes when interest rates move, and God knows how much interest rates have moved in the past few years. And as a result, it also has a value at risk. So all this stuff, which kind of wasn't really on the agenda or in the conversation for the past decade, are now pretty obvious, and everyone is interested in them. The good news is that infrastructure remains as far as we can tell from these results, a really attractive investment. It's a portfolio diversifier. We're just finishing a study on strategic asset allocation, and it clearly shows that if you include infrastructure as we measure it, with the volatility and the correlation with other asset classes, you find a really interesting addition to the total portfolio. And as I also like to point out, it has a great cash yield, and it continues to have a great cash yield. And this is, again, one of the main characteristics of infrastructure, which is that these are businesses that are capable to pay out a large fraction of their revenue as dividends. So that's different from a lot of other types of assets. But it is also risky. All right, if you want to know more and if you want to access all this information, I invite you to log into our platform. And if you need a demo or anything, you can use this information to find out more. And my colleagues can also help guide you through the platform. If we have any remaining questions, let me have a quick look. I think we answered most of them during the webinar, but no, I don't see any other new question. So super. And we've only just run out of time by 5 minutes. So thank you very much to everybody. And again, thank you for listening and for participating. Quite a lot of questions today. We will send this information around as well, and there'll be a replay on our website in the next few days. So thank you, and bye-bye.